Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Copper demand grew throughout this quarter after we announced Blackwell. And so that kind of tells you how much demand there is out there. People want to deploy these data centers right now. They want to put our GPUs to work right now and start making money and start saving money. And so that demand is just so strong.
There is no slowdown in terms of order growth going into this upcoming quarter or the past quarter in regards to, let's say, holding off on buying the Hopper series in favor of the Blackwell series that's going to be coming out in the fall. So I think that put to bed that concern, at least for now. And of course, the stock has responded on the 10-for-1 stock split and all the other good news, and we're moving at higher levels right now. So very good report across the board.
We're going to go from Nvidia shipping basically chips to their customers to shipping full server rack solutions. So that's going to be a pretty significant driver in terms of revenue inflection going into next year as well.
We got 1 hour to go until the market close, so we are taking a look at the major averages, which are near the lows of the day. Nvidia notwithstanding. So let's go through it here. We've got the Dow that is leading the way downward here. Right now, it's off almost 600 points or about 1.5%. On the flip side, the other averages are not doing quite as poorly. Let's just refresh over there and take a look at those other major averages here. So we've got the S&P 500 down 0.8%, not quite as steep. And then the Nasdaq, better still, or less worse still, down by 0.5%. We did get a measure of the services economy this morning that came in hotter than estimated, and so that perhaps putting a little bit of pressure on, but really the acceleration of selling came into the afternoon. There was a bond auction that might also be weighing on things, but we've got the 10-year back climbing closer to 4.5%. But also the divergence between the Dow and the Nasdaq today is also a story of two individual stocks, at least to some extent, and they also happen to be the two top trending tickers on the Yahoo Finance platform. Of course, we've got Nvidia in the number one spot of 9.3% right now after that company came out with sales that beat estimates, earnings that beat estimates, and a forecast that was ahead of estimates, as well as that 10-for-1 stock split and a little bit of a bump up in that dividend. And then the number two stock is Boeing. Now, Boeing is important for the Dow in particular because it's a price-weighted average, and it has a decent weighting in there because of the price of Boeing. Those shares are down. We are going to explain why later in the show, Josh.
Julie, stocks are accelerating losses ahead of the close after Nvidia's blockbuster earnings lit a fire under AI optimism for investors. For more on the report and what it means for the broader markets moving forward, let's welcome in here Ryan Dietrich, Carson Group Chief Market Strategist. Ryan, it is great to have you on the show. So, you look at Nvidia, as Julie was saying, Ryan, Nvidia reports, they beat. Street loves it, investors love it, the stock rips, but we look at the major averages, all three in the red here, Ryan. How do you explain it? What's going on here today's trade?
Back, Josh. I mean, you're right. Nvidia is the all-star today. It's been the all-star all year, we know. But just today, I mean, we'll see what happens the final hour. I know we've got an hour to go, so maybe some buyers step in. But my take is this. We've had a heck of a run right before today. The S&P's up over close to 6% for May. We've had a good run. Maybe it is almost just some sell the news. I know we're not selling the video very much, but everybody had that bullseye all month really with this news. And it's not like anything major has changed. Maybe markets are just due for a little pullback consolidation. I'm not overly concerned so far today.
Hey, Ryan, it's Julie here. So how are you thinking about NVIDIA specifically and sort of tech more broadly? Everybody was anticipating those results. They came. They did better than expected. Now what?
Yeah, the joke I said before was death, taxes, and NVIDIA beats on earnings. I think those are three things we can always look forward to, or maybe not look forward to in some of those cases. But nonetheless, big picture, we're more neutral right here, technology, Julie, and it's not because we don't like it. It's just if you look at valuations like the last 20 years, keep this kind of simple, tech valuations are like 2 standard deviations above their long-term average. That means they're really pricey. Doesn't mean you can't be in it. Again, we're more neutral tech. To us, we look at some of the other areas, financials, industrials are really cheap historically, and then small caps and mid caps. Now, I know those are kind of dirty words. A lot of people have talked about them before, but to us, the second half of this year could be more of a rotation, not necessarily out of tech, so to speak, but just into some of those areas that are a little bit cheaper. Again, as the economy is strong, we get into that if you want, and we think the economy is going to be strong, and those areas should do pretty well.
And so, Ryan, so financials and industrials, just let's drill into those a little bit. Is it just a valuation call, or no, there's other variables at play there?
Great point, Josh. Other variables, I mean, plain and simple, we're pretty optimistic about the economy, right? We think this economy is going to continue to surprise the upside. We've seen earnings surprise the upside. We think those cyclical names will do better. Kind of put a bow on this. Productivity, we have not had strong productivity in our country for a long time. Over the past year, we've had about 2.9% productivity. That's pretty darn good. Josh, we think productivity can continue to stay strong going forward. And what does that mean? What does it mean to the listeners out there? The mid to late 90s was the last time we saw strong productivity. That's kind of that magic elixir that allows for GDP to come in better than expected and earnings. Remember last year, nominal GDP came in at 6%. We were bullish. We didn't think it'd come in at 6% last year. Nobody saw that, but a lot of that was probably strong productivity. So that's why we like the cyclical areas.
And so what are some of the specific cyclical areas that you guys, I mean, like I think of tech as a cyclical area too, but you'd rather look elsewhere here.
No, good point there. We would. I mean, specifically, financials and industrials are the two groups that we are overweight. Your materials and energy can lump in there. We're more even weight there. But I think, again, it's just where's the opportunity, right? What's the market? The market's always forward looking. I mean, there's a lot of earnings growth potentially going to come in the next 12 months from small and mid caps. People aren't talking about that. And again, small caps, if you look relative to large caps, are as cheap as they've been in like 25 years. Now, just because something's cheap, it doesn't mean you want to go into it, but we're optimistic. We're going to see some better inflation data starting to come. We started to see rent prices start to crack a little lower. That should lead to OER. I don't want to get too in the weeds here. We know shelter is a big reason why inflation's been stubborn. We think inflation is going to really improve, and that can open the door for 2 Fed cuts. And again, small, mid caps, and cyclicals should benefit, in our opinion, the rest of this year.
And I know, Ryan, listen, we got a down day, but it sounds like you see the market continue to kind of move higher here over the summer. And it sounds, Ryan, like in part at least, are you letting kind of history be your guide there?
Yeah, we do. We think, look at history. I mean, I've come on with you guys for a while, and we've said election years, when you have a president up for re-election, been higher 10 of the last 10 times. You don't blindly invest in that. But what you tend to see in an election year also, Josh, is a summer rally. June and August usually aren't that great. They average about 1.3%, pretty good in election years. So we think, again, a surprise summer rally and even strength the rest of this year does make a lot of sense. But it comes down to the fundamentals. Earnings, profit margins, and CapEx, capital expenditures are all really strong. I mean, that's the main reason we're optimistic. And then we look at kind of history and think, hey, history doesn't repeat itself. It often rhymes. Mark Twain, we all use that. And we think we could have a summer rally and a good end of year.
Well, and it's interesting because you also note that this is on pace to be the best start to an election year ever. So what's that about, and how do we sort of contextualize that historically?
Yeah, might have jinxed it with the action today, but yeah, I'm teasing. But I did that as of the end, the first 5 months of the year. 1976 is there, and again, usually election years aren't that strong to start off the year. Let's just keep it there. But this is quickly becoming one of the best election years we've ever seen, with a couple days to go this month. Now, here's Julie. What's interesting? Today's the 100th trading day of the year. What in the world does that mean? I looked back and found 20 times the S&P was up double digits as of the 100th trading day of the year, like we're going to be today, assuming we don't have a major sell-off the next hour. The rest of the year was higher 85% of the time, with an average return of 9%, median return of 10%, both those numbers well above the average returns. Long story short, a good start to a year historically has been great. One final thing, these years might ring a bell. 2021. 2019, 2013, 1998, 97, 96, 95. Those were the last years we had double-digit returns on day 100, and every one of those years gained at least 10% the rest of the year.
A body in motion tends to stay in motion, as they say. Thanks a lot, Ryan. Great to see you as always.
Appreciate it, guys. Thank you.
We're just getting started here on Market Domination. Coming up, the Justice Department is widening its antitrust crackdown as it goes after Live Nation. We'll explain the suit and what it means for the online ticketing industry on the other side. Plus, shares of Synopsys higher today. CEO Sassine Ghazi will join the show to chat about its earnings report.
And at 4:30 Eastern Time, it's the latest edition of our new show, Asking for a Trend. Got you covered with the biggest market-moving stories, including conversation with Elf Beauty Chairman CEO Tarang Amin, as those shares are trending higher this afternoon. Stay tuned, more market coverage after this. Checking in on some of today's top trending tickers, shares of Boeing sinking here after the company's chief financial officer, Brian West, said the jet maker will continue to burn cash in the second quarter and in the full year as it continues its turnaround efforts. So company CFO here, Julie, says the cash burn in Q2 is going to be similar, maybe even worse than the first 3 months of the year. Remember, Boeing then lost about $4 billion in cash, so no surprise investors didn't love that. You saw the stock drop.
Yeah, and these comments were made at a conference where Finance Chief Brian West said, "We have frustrated and disappointed our customers because of some of the production and supply chain issues we are up against." Remember, jet deliveries in April for Boeing were the lowest since the start of the pandemic. So you can sort of understand here why they're still having cash problems. They also made some comments, or I should say also there was the news that China was stopping delivery of MAX 8 jets. It's doing a battery review. That news coming this week as well. It looks like a temporary stoppage, but that's something also that is of concern to investors.
And it looks like it's impacting cash generation That's the issue there. Yep.
Yeah, exactly. Let's talk about another trending ticker that we are watching closely. The Justice Department is widening its antitrust crackdown as it goes after Live Nation, filing a lawsuit Thursday that seeks a breakup of the entertainment giant. Yahoo Finance's Alexis Keenan here with more details. Hi, Alexis.
Hello.
This is something perhaps we suspected ever since executives got hauled before Congress, the Taylor Swift effect, etc. But now we know the details.
Yes, so everyone saw it coming, but it is a very sweeping lawsuit. And what the DOJ is alleging against Live Nation is that it is using coercive tactics and that it violated agreement that it entered into after already getting approval from the DOJ back in 2010 to go ahead and merge with Ticketmaster. That was under the Obama administration. And then another revised settlement agreement to keep this merger intact that happened in 2020. So what the DOJ is now saying is that they are acting as a gatekeeper over the entire industry in the US for live music. So the ecosystem that does allow promotion and events to actually get carried on in the US. Now, who are they saying is being harmed here? They say artists. As well as venues, fans, competitors. As for artists, they say that artists are being blocked from venues and that Live Nation is strong-arming artists and saying, well, unless you use our promotional services, you're not going to go to these top venues. As for venues, they say that they're pushing on these venues these long-term contracts that say you must exclusively use Ticketmaster for the ticket sales or else no go. Also, fans controlling how they purchase their tickets, controlling the fees that they pay. And if you look at the list of fees that are in this complaint, you have service fees, platinum fees, VIP fees, per order fees, handling fees, payment processing fees. You get the idea. Yeah. I just went onto the website on Ticketmaster just before we came on here and tried to buy a $300 worth of tickets, so 2 tickets, and on top of that, it became a $359.95 deal. So they don't like that. They think that is not good for consumers, not good for competition. As for Live Nation, they said that Ticketmaster is not a monopoly at all. They say, and by the way, this lawsuit will not solve this problem that consumers are having with the fees because the bulk of the fees, they say, go to the venues. But this is really rare. The DOJ here is asking for a breakup. They're putting that on paper. They say, at the very least, we want you to divest Ticketmaster. And what do analysts say that will do? They say, well, that will leave the company as just a shell of its former self because the bulk of the fees, the bulk of the profits are generated through that Ticketmaster operation.
I mean, I remember, I'm old enough to remember, when Ticketmaster didn't belong to Live Nation.
Right, you and me both.
And the fees were still high.
They were still high, so there may be some merit to that.
So it's just, I just wonder, will this really solve what they're trying to solve for? Or would there need to be some sort of legislative remedy for ticket fees instead? Not that Congress has moved on that. They've talked about it, but we haven't seen them
so you have control of the market-wise. The percentage share, according to the DOJ, is that on the ticket sales side, Ticketmaster is holding 80% of that market. That's a decent share.
It is, but what was it before Live Nation bought them?
I don't know that answer. We can find out either. Our next story. And on the promotional side, they say it's 60+%. So they really make these allegations like they have in some of the other complaints that have come to antitrust complaints under this administration. They say it's this confluence of activities, these strong arming of different parties, and they say that there's collusion, really. They don't necessarily use that word, but they say that there's also acquisitions of smaller promoters that have come along the way. So, maybe some points will be taken by a judge. They're asking for a jury here. That's also a new kind of move by the Justice Department. It doesn't happen very often in antitrust.
Hoping for some Swifties on that jury, I bet.
Yeah, of course, this all came up because of that meltdown with the Taylor Swift sales. So a lot of attention came after that.
Yeah. Thanks a lot, Alexis. Appreciate it. Well, shares of Arista Networks down today following Nvidia's earnings report. The chipmaker plans to focus on a brand new market to bring large-scale AI to Ethernet-only data centers. And just more broadly, on the conference call, we heard some commentary about the networking business and how they plan to build there. Jensen Huang, the CEO, talking about their new Spectrum X for Ethernet, but he also said, you can count on us having new networking technology on a very fast rhythm. And so that seems to have sort of spooked Arista Networks.
Yeah, I did see analysts at Bloomberg raising some questions here saying, yeah, sure, it's a natural transition for Jensen Huang, but details, they said, are still needed. They believe hyperscale cloud customers still prefer an open vendor ecosystem to reduce the technology economics, which will continue to position, here their words, Arista well in cloud AI networking. And the street is indeed overwhelmingly bullish on this name, right? Julian, the stock has had a really strong month. It's up about 30% this year. Even now, it's up about 110% over the past 12 months. But listen, you can't blame investors when they get a little nervous if you hear Jensen Huang and Nvidia, or are getting curious about the sector you operate in.
Yeah, and expanding in that area as well, for sure. Well, staying in the chip-adjacent space, Synopsys shares jumping after that company reported better than estimated second quarter results and raised its full-year guidance. Joining us now, Sassine Ghazi, Synopsys CEO. Sassine, good to see you. Thanks for being here.
Great to see you, Julie.
So obviously a lot of excitement around the broader chip space right now. You guys, of course, recently announced that you were working with Nvidia, although you already had relationships with them. What would you say was really the element or elements powering your numbers this quarter?
Yeah, we're seeing strong performance across the portfolio. Remember, we have two parts of the portfolio. We have the design automation, which is the software used by the chip designers to design their chips. So when Jensen talks about Synopsys as mission critical to their development, that's where they use our software to design the chip. The other part of our portfolio is design IP, which you need to think of it as part of the chip, like Lego blocks of the chip design that we have them prepackaged and again, used by either the chip developers or the semiconductor industry or hyperscalers for that matter, that they're developing their own chips. They use the software and the IP from Synopsys. So the strength was driven by both segments.
So see, it was interesting to hear Jensen sort of talk about the AI moment we find ourselves in and kind of just the language he used to see. He said the next industrial revolution has begun, he said. I'm just curious, is that how you see it, Sassine, that we really are in this sort of historic moment here?
I do. But I believe at the same time, we're in that early phase. That first phase is building out the infrastructure. The AI is driving a massive compute requirement, and you see most of these investments happening in data center for the obvious reasons. Then the second part is the networking to connect these data centers and these chips together. The second phase, where you can call it the industrial revolution, is going to happen when all systems become intelligent systems, meaning your car become more intelligent, your home more intelligent, meaning connected both from an inference and connected to the data center or on the edge for compute.
And Sassine, I know I ask you this every quarter, but we keep talking about sort of incrementally. When you say you're early in that AI revolution, especially as it pertains to you guys, what are we seeing that you can directly attribute revenue-wise to AI right now? And also, since shareholders just approved your acquisition of Ansys, assuming that still goes off, gets regulatory approval, how much will that grow the AI business as well?
Yeah, so when I'm saying it's still early phase, I'm talking about the early phase of the overall market. When you look at the data center consumption of building out the compute, the intelligent system, etc. We, as a software provider, we started selling our AI embedded in our software in 2020. So we've been 4 years into that cycle. And now we're able to communicate to our investor that it's contributing about 20% uplift in the domains where the customers are using AI for. So we're already seeing the benefit and a very rapid pace of adoption of the technology. But to give you a sense, we're only about 20%. Now you can argue 20% is too high for AI in terms of adoption, but it's growing very nicely. And so we're already seeing that value already from our software monetization using AI.
And Sassine, on that question, the acquisition of Ansys, where are we there in the process, Sassine, in terms of regulatory approvals?
So about 4 or 5 weeks after we announced the acquisition, we started the process. So with the FTC, we're into phase 2. With the EC-CMA, we filed in April, and we're going through the process. With China, the first phase or step was to communicate that we are below the merger threshold. the merger filing threshold. And last week, China confirmed that we are below the threshold, but still expressed interest in reviewing the deal. We're still targeting the first half of 25, and actually we're feeling that this process should be manageable to a positive close.
Finally, Sassine, I wanted to ask you sort of about the broader corporate spending environment right now, right? You wouldn't know that there were any questions about economic growth looking at your results, but I'm curious what you are hearing from clients, if there are any changes that they are making at the margin.
So if you zoom out and look at market segments, of course, anything related to AI, our customers are investing and ramping up their R&D capability. The second segment that's actually fairly exciting, and we talked about it in our Q2 report, is automotive. Automotive, we have seen the push and the need, regardless if it's EV or not, but to make the car more autonomous, meaning more infotainment, ADAS type of application inside the car that requires more sophisticated chips. The third market that we're seeing that early interest in going deeper into electronics is anything industrial, to go back to a more intelligent industrial manufacturing and systems. Now, there is a talk, but I'll contribute it to be more 4 or 5 years out, is anything around life sciences. So that's where we're seeing the general landscape. And of course, anything hyperscale, it's driving significant growth due to the build out of AI.
Sassine, it was great to have you on the show today. Thanks so much for taking the time to join us.
Thank you. Thank you for having me.
And coming up, Wayfair is opening its first ever large format store in a Chicago suburb. Today, we're going to get a closer look at what it means for the retail that's coming up next. Stay tuned. More market domination still to come. The world's leading PC maker beat on earnings today. Lenovo more than doubled its net income in Q4 and marked a third straight quarter of better than expected profit. Company is one of the first to bring AI laptops to market with the hope that devices will become new growth drivers. Joining us now is Ryan McCurdy, Lenovo North America president. Ryan, it's good to see you. So looking through the report, 9% pop in Q4 revenue. That was a beat. Profit beat too. Maybe let's just start there, Ryan. What drove the quarter here?
Hey, thanks for having me. It's great to be here. Yeah, very optimistic, the report that we came out with today. As you said, we remain the world's largest PC manufacturer, really leading this PC market resurgence, and we continue to diversify our portfolio beyond PC across data center and our services business. You know, I'm responsible for North America, and that business was up 11%. And really more than the quarterly results, which are great, I'm encouraged by the trend. This is our second consecutive quarter of revenue growth and profit growth across all of our businesses. So we're really focused on our performance in North America against our competitors. And after 10 straight consecutive quarters of decline, IDC reported that the PC market showed its first quarter of growth, and we reached the highest PC market share we've had in our history at 18.2%. So really, and it's the fourth consecutive quarter that we've outpaced the market. So for us, that illustrates that we've successfully navigated this industry downturn, and we've moved past that, and we're really ready to capture this enormous opportunity of hybrid AI.
So Ryan, what is driving the rebound that you're seeing? Is it enterprise? Is it retail? Is it, I believe, I don't know if your AI stuff was all in place last quarter and the numbers were reflected there. You know, what are some of the drivers here?
Yeah, I mean, the AI PC really represents a new category. You know, if you look at the forecast, their IDCs are forecasting that, you know, AI PCs will be about 60% of all PC shipments by 2027. So really, we're at the front end of that, and we're seeing tremendous interest in that as our new products will come to market this summer. So as you reported earlier this week, in partnership with Microsoft, we unveiled our next generation consumer and commercial AI PCs. Two of them in particular, powered by Qualcomm Snapdragon lead processor. These are our newest offerings. They're out this summer, as I said, Lenovo Yoga Slim 7 and our Lenovo ThinkPad T14. Really, I think there's excitement for this as there's new levels of personalization and performance across our portfolio. So, and you asked where the growth is coming from. I think the industry is ready. You know, it's kind of repaired over the last couple of years, and there's just a lot of excitement that the refresh that is upon us, this refresh cycle that all of our partners and customers are anticipating after 5 years of COVID and constraints, ready to really look to upgrade and bring these new capabilities to the market.
Ryan, you mentioned the Yoga Slim 7X, which I love the name of that one. Is that a product? I've seen some reviewers say it's sort of designed to take on the MacBook Air, Apple's MacBook Air directly. Is that how you see that product? And do you expect to take some market share from Apple?
Yeah, I do. As I said, it represents a new category, and I think they're purpose built is the way we look at it. They're built to handle the advanced AI workloads. They're using modern and custom hardware and software. So latest CPU, GPU, NPU, you might have heard the term NPU, it's less familiar, neural processing unit. This is purpose-built chip for AI, but Lenovo also has our Lenovo AI core chips. They work with the existing CPU, GPU architecture, and they basically dynamically adjust power and efficiency depending on the task that the user and the workload that's being used. So I think these are exciting new products that are purpose built, and yes, they're meant to attract new users and users from other ecosystems. And very excited with the broader ecosystem and our partners. There's a lot of excitement around the AI PC launch.
And Ryan, I was reading that you're working with Microsoft on these AI PCs outside of China, but inside China, no. So what AI features do your Chinese customers then benefit from, and who's providing that, Ryan?
Yeah, so there's some custom Lenovo software in China for China. We're really working on a broader common ecosystem. Every one of the products that I mentioned here today is equipped with the Windows 11 operating system, Copilot Plus functionality. So that's for our rest of world operations, where I'm focused. And really where I'm focused is in business and consumer and bringing products across the portfolio in North America to service that market.
Are you seeing any kind of issues related to the tariff environment or the trade environment that's affecting your supply?
No, honestly, after the last 5 years, it's probably the best that I've seen it. There's obviously in hundreds of millions of components. You have constraints here and there, whether it's supply chain, different issues. But really, I think we're in the cleanest place we've been. I think we're ready to as I said, take advantage of the opportunity that's in front of us. Just an enormous installed base that exists in the market here over the last couple of years. So. Look, there's always some issues, but I think we're probably in the most healthy position that we've been in several years.
And Ryan, obviously you got a lot of enthusiasm there for AI PCs. What about AI-enabled smartphones, Ryan? Are you also enthusiastic about that category?
Yeah, I mean, we're enthusiastic across the whole portfolio. If you look at like one of the true differentiators for Lenovo, I think it's our Pocket to cloud portfolio. So Pocket is the Razer, Motorola line of phones, and all the way to the cloud and everything in between. So when we look at this, we see the opportunity. When we say AI for all, we look at hybrid AI. So at Tech World last fall, we announced our hybrid AI approach, and that's where public, private, and personal foundation models coexist. And we think this is a world where AI can operate exclusively within a device, a phone or a PC, or securely in a data center, and protect the privacy of users. And as you're aware, the need for AI infrastructure, especially in servers and storage, is going to dramatically increase over the next 3 to 5 years. We're just seeing hybrid AI driving greater demand for infrastructure, and customers are increasingly asking for custom solutions, particularly consulting, design, deployment, and maintenance of AI. So really interesting time, and we continue to build out that portfolio with our ecosystem partners. In just the last 2 weeks, we've announced new offerings with Nvidia, NetApp, and Nutanix. So I can go into more detail on those, but really exciting time with just a lot of innovation and a lot of work being put into the overall portfolio from phone all the way to the data center.
All right, Ryan, thank you so much for taking the time to chat today. Appreciate it.
Thanks for having me.
Now let's get to some calls of the day. Telsey Advisory Group, they downgrade VF Corp from outperform to market perform today. So VF Corp, obviously owner of Vans, Dickies, Timberland, reported a loss and another quarter of falling sales, as we talked about yesterday, Julie, when that print crossed. Telsey's Dana Telsey, and Dana has been doing this a long time, so when she speaks about retail, people do listen, did cut to market perform, slashes her price target to 13, says the results were disappointing with revenue, gross margin, and operating expenses coming in short against consensus there, says this was a sizable miss.
Yeah, and she had been had faith in the stock and had been patient with CEO Bracken Darrell, who took over in October. But she said what he's doing is not really bearing fruit here. She says he introduced a transformation plan, but she said since then, in her note, the company's two largest brands, Vans and The North Face, have remained under significant pressure, driving the overall top-line decline. She also notes that the company had done a strategic portfolio review. I mean, they own a lot of different, something like a half dozen different brands, and she said they finished the review, but they didn't reveal what the review found. So she says that sort of makes things a little murky as well.
I would just, I also had Sam Poser at Williams Trading, like Dana, long time retail analyst, cut this name to sell, says its transformation plan has clearly got a long way to go before it gets the core brands working again, and optimism appears unfounded, he said.
I like it that he says, even if some brands are sold, the remaining brands will not magically improve.
Right.
So there you go. Well, coming up, AI demand isn't going anywhere. We're going to tell you the best ways to position your portfolio in the chip space with today's investor playbook. Stay tuned, more market domination still to come.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
AI demand isn't going anywhere. That's the clear message from Nvidia's stellar first quarter results and robust second quarter guidance. Even as AI evolves past the training stage, Nvidia founder and CEO Jensen Huang told us he still believes the company is well positioned. Here's what he said.
We have a great position in inference because inference is just a really complicated problem. And the software stack is complicated. The type of models that people use is complicated. There's so many different types. It's just going to be a giant market opportunity for us.
We're looking at how to navigate the future of AI with the Yahoo Finance Playbook. To discuss, Ben Beharin, CEO and Principal Analyst at Creative Strategies, and Paul Meeks, Co-CIO at Harvest Portfolio Management and partner at Wall Street Beats. Thanks, guys, for being here. Really appreciate it. Ben, I want to start with you. What Jensen was sort of referring to there, and there has been some questioning from the analyst investor community about this move from training to inference, right? From when AI models are learning stuff to when they're doing stuff, right? When they're analyzing and forecasting, and whether NVIDIA chips would be best poised for that, especially given their cost. Did this quarter and forecast put that to bed, or do we still have questions about the future growth rate?
Yeah, I mean, I don't think it put it to bed, right? This is a highly competitive market. You've got Intel, AMD, you've got the hyperscalers doing their own inference chips and AI accelerators. So clearly there's a battle for these workloads. I think that's the best way to really think about it. That said, I think the argument that he's making is really that the NVIDIA systems, right? And it's not just GPUs, it's the whole systems. It's the CPUs that are on board, it's the networking, it's the memory, it's everything that they build is going to be the best total cost of ownership for these workloads. And so there's good argument for that. I think you can make that case. I really don't think we know the answers to that yet, but I do think this is becoming the most interesting thing to track, which is one, what are those workloads that are inferencing? We want NVIDIA to give us more details of that. And then secondarily, does that number continue to grow each quarter, and that they do run more inferencing workloads on their DGX systems?
And Paul, let's bring you in here as well and kind of start big picture here, Paul. Interested just to get your take on that NVIDIA print. They reported they beat, Paul. Investors love it. What did you make of the report, Paul? And what did it teach you kind of about the bigger, broader AI theme in trade?
Well, the thing that I was looking for was not any metric in particular financially. It was tell me the vision and make me feel more comfortable coming out of the conference call that there is a longer runway for NVIDIA in all kinds of facets of AI infrastructure build than we thought. Because the issue with NVIDIA is, with the stock up 3-4-fold last year, doubled already this year, is do they ever run into a growth wall? Because if they do, only 2 fiscal years ago, this company only earned a couple dollars per share. Then it goes to $28 this year, probably $35 to $40 next year. But if they actually see at some point, and I'm not saying when, any sort of slowdown in spending, the stock used to be much lower because its earnings power was 3, not 45 or 50. So that is the absolute key. And I think Jensen Huang did a nice job yesterday articulating the vision. Only he can do that to make us feel that they've got their bases covered and they're not going to peak, just as Ben said, necessarily with large language model building.
Well, and the interesting thing is, even if spending doesn't go down, if it doesn't keep up at the same rate, and it doesn't look like it necessarily is going to, at least if you look at the revenue projections, then NVIDIA might not be in the same position. Ben, as you said, there's a lot of competition out there. So does that mean investors at this point, is it too early to look to the competition to invest or to look to the bigger ecosystem to invest?
Yeah, I think this is where the work's really got to come in to really understand where these workloads are going to go. Looking at where a lot of big businesses and enterprises are going to want to run their workloads either in the cloud or on-prem. And I do believe there's something to this AI factories, sovereign AI, that's going to happen. But does that mean that's totally NVIDIA systems? I think that's still an open question. It's really going to come down to cost, right? We know that running inference is a big part of the workload, and one of the most important parts about inference and what you need to do technically is you need to be able to handle millions upon millions of people at the same time querying and getting predictive response and doing all the AI things that we talk about. And so can every other product handle those concurrent inference workloads? Jensen brought this up on the call. It's something that we hear regularly as people are exploring where to put those workloads in the cloud. So I do think that there's an argument to be made for NVIDIA, but again, as we said, right, there's a huge set of competition out there. And this inference point is the sole reason why Google's doing TPUs, Microsoft's doing Maya, which is their accelerator, and why Amazon has Inferentia, their inference engine, is they're doing it to build these workloads for those. So it's very competitive, but I just don't think we have an answer to where all these workloads are going to go yet.
Paul, beyond NVIDIA, let's talk about another name you like, which is Dell. That's another name, Paul. It's an AI play. It's another name investors have piled in. Why is Dell a buy here, Paul?
So I do think that there'll be a continued strength in server demand. I've played very successfully Supermicro over the last couple of years. However, that stock seems to be stretched to me, so I'm looking to carry on with the same theme. And when I take a look at the other players, I much admire Dell. I don't necessarily admire HP's management team, don't have confidence, or at least enough confidence in their execution. So Dell is my way to play it because Supermicro has already been too good of an investment for me.
And Paul, what about, the hyperscalers themselves, right? Not necessarily the infrastructure as much, although I guess you could call the hyperscalers infrastructure. But I'm just curious if you think that they're also a good way to play this.
Oh, yeah. I own the hyperscalers. I will say or take, some offense to a point made just now that there's competition coming. I think a lot of these AI chip companies, yes, they've been talking about stuff on the podium. They have it in press releases. They have it in PowerPoint presentations. But frankly, I'll believe it when I see it. So I think the threat on the AI chips is less for NVIDIA than people are making it out to be. I really think AMD will get there before too long. Company super well managed under Dr. Lisa Su. But here is another competitor, Intel. Intel has sucked for a couple of decades. And so they're taking the company in the right direction. But come on, when they talk about their manufacturing process, let's see it first. But I do think the hyperscalers are a way to play it. And of course, another way to play it is some of the other companies in the AI ecosystem. I mentioned Dell. We got Supermicro. Arista Networks looks pretty interesting today, down 5% overnight. So those are some of the plays instead of just piling into NVIDIA, which I've already done.
Well, Ben, respond to that if you would. I mean, you guys are smarter on the technical stuff than I am, to be sure. So Ben, I'm curious, Jensen Huang would probably agree with Paul and say this is very difficult to do at the advanced level that we do it. So really hard to come up with a new chip to compete. But exactly how hard is it, I guess?
I think the best way to think about this, and this sort of ties to a little bit of the segment that you had before about what's going on with AI PCs. I was at the Monday launch with Microsoft and Copilot PCs, and they made a big deal of this new thing called the NPU. And so why are all these AI workloads moving to the NPU, or why are they making this a big deal in that you want to run these things on this workload? And basically what it comes down to in terms of the sheer efficiency of running AI workloads for saving of power, right? So giving you battery life, the NPU is the best way to do that. Everybody that runs these workloads in the cloud just completely knows that GPUs are amongst the largest energy hogs when it comes to these things. And that's really where this inference debate goes. So you can think of what Microsoft's doing with Maya, or what Amazon's doing with Inferentia, and Google's doing with TPUs, which already have a tremendous amount of customer success and they're already proving this in the market, and they have a whole host of customer success stories, economic stories, money saving stories, performance per watt stories. So there's and the way I think of those accelerators is they're basically NPUs. And that's really what they are. And there's a whole roadmap for these companies. It's not stopping here. They've got a long, long roadmap. And the bottom line is they're optimizing their software so that when a company comes to them and says, here's my AI workload, their software is deciding where it goes. And this is just the ultimate trend of the hyperscalers. So yes, people can choose to run those on the GPUs if they want, or a whole host of businesses are just going to say, I'm bringing my workload to your cloud, I'm writing my cloud in your software, and that abstraction layer at a Google, at Amazon, at Microsoft will then decide where those workload goes. So there's a portion of this that is actually outside of NVIDIA's hands. They don't want to talk about that because the hyperscalers are going to be in a position to control those workloads. And this is why they're investing in those strategies. It just saves money and it saves energy. And we know that that's a huge deal in the hyperscaler route. And that's why I think over the course of the next few years, you will see a far more diversification of workloads because it makes economic sense and it's better from an energy savings standpoint as well.
Ben, Paul, that was a great discussion, great debate. Thank you guys for joining us.
Thank you.
Thanks for having me.
Nvidia's blowout quarter shows demand for data centers in the age of artificial intelligence is insatiable. The challenge, according to experts, will be powering that boom. Yahoo Finance's Inez Ferre is here with more. Inez.
Yeah, guys, and I spoke to one expert that told me the utility industry is not prepared for the demand for data centers that is coming down the pike. The power industry had already been preparing for the adoption of EVs, more onshoring, and industries that require more power. But the energy demands of AI just add a whole other layer of complexity to the grid, because even though chips require less energy, they are so powerful and can do so much that their usage increases even with the next generation of chips. And it's not like EVs where the demand is linear. The demand literally can happen overnight. There's a McKinsey study that shows that power demand for data centers will more than double by 2030. And I spoke to one data center operator that told me they're seeing unprecedented demand from hyperscalers, cloud as a service providers, and also enterprise banks, pharmaceuticals that want to use AI data centers for their operations. He said the bottleneck used to be supplies. Now the bottleneck is power, energy demand.
So Go ahead. So following this was how are utility companies kind of responding to that demand?
They have been racing to respond to this demand, and they have been mentioning the demand from data centers in their earnings call more and more. You had the Southern Company in Georgia that said that their sales to data centers increased 12% year over year last quarter. Dominion in Northern Virginia, where there are a lot of data centers in that area, getting regular requests to support large data center campuses. And then you have Constellation Energy. That is the nuclear play that Wall Street is so endeared with. And Constellation's base earnings are expected to grow 10% through the decade. And what Wall Street is most bullish about with them is that they have been having conversations with some of the hyperscalers. So could they team up with a hyperscaler to actually have a data center right next to one of their power plants, and they can just hook right up?
So interesting. Well, we'll count on you to continue to follow this because it's not going anywhere.
No, certainly not.
Appreciate it, Inez. Well, while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell.
And at 4:30 Eastern Time, it's the latest edition of our new show, Asking for a Trend. Got you covered with the biggest market-moving stories, including a conversation with Elf Beauty Chairman CEO Tarang Amin, as those shares are trending higher this afternoon. Stay tuned, more market coverage after this.
There's the closing bell on Wall Street, and now it's market domination overtime. We are joined by our Jared Blickery to get you up to speed on the action from today's session. Let's talk about where the major averages ended up here, because interesting story here today is we really saw deterioration in the Dow in particular throughout the course of the session, finishing off by more than 600 points. That's a 1.5% drop. Some of that drop because of Boeing falling after its finance chief and CFO speaking at a conference and talking about the cash flow challenges that the company still faces. The S&P 500, though, did not escape the selling. It was down about half as much, about 0.75%, and the Nasdaq helped a little bit by Nvidia, off only about 0.4%. And speaking about Nvidia, I just wanted to check on where that stock closed on the day here, up by 9.3%. That is a record close for Nvidia. Let's max it out, shall we? Just for fun here. 227,000%. I didn't know what number this was going to show, Jared, when I maxed it out. But obviously, in the last few years have been, in particular, just blockbuster for that Nvidia stock.
Well, thank you, Julie. We should go and measure the 20-year returns of the S&P 500, see what turns up. Might be a few surprises, but what is a slight surprise here is all 11 sectors closed in the red, and that is a different picture than what we saw in the open when we had the S&P 500 opening at a record, Nasdaq opening there or near a record, and it was just kind of downhill ever since. Now, if we take a look at our leaderboard here, it's a very similar story. You see cannabis is actually the weakest sector, and also Bitcoin taking a hit, solar energy, which was popping yesterday, and also disruptive tech. So basically all the fringier areas of the market seeing a lot of red today. I do want to show the semiconductor heat map because in addition to Nvidia, we do have some other green. Taiwan Semi up 0.6%, ASML up over 1%, and Marvell up almost 2%. But for the most part, we're seeing a lot of losses here. Global Foundries down 8%, Intel down 4%, AMD down 3%. So kind of a bellwether for the rest of the market. Take it as you will, but I'm going to be doing a deep dive into today's price action in about 30 minutes, guys.
Thank you, Jared. Markets closing the day well in the red following another blockbuster earnings report from Nvidia. So where does attention turn to now? Let's welcome in Sebastian Page, T. Rowe Price, Global Head of Multi-Asset and CIO. Sebastian, good to see you on set.
Thank you. Thanks.
So as Jared was just saying, listen, day in the red. I'm curious, Sebastian, whether you see any kind of broader, deeper signs of stress in the market that would indicate to you maybe this is just kind of the start of something nastier.
Look, we could get a pullback further than what we've seen today. The economic data is decelerating, and you see this with the PMIs. And we've had a really, really, really good run in the stock market. But if I step back and I look 12 months ahead, I don't expect a recession. I think stocks will do okay. I think credit will do okay. I think the market is due for a broadening. I also think AI is going to continue to boost spending and earnings. It's real. The thing I worry about is that we're pretty far from the 2% inflation target that the Fed has set for us. So we're positioned slightly long value stocks. It's not like we don't like growth stocks. It's just that we think the market will broaden towards value stocks. And that in part reflects our macro views.
And you summarized that strategy by saying, be boring.
Yeah.
Which I love that framing of it. And is that what you mean by that? Sort of be slightly long value, don't expect maybe more fireworks, or don't try to position for more fireworks in the market?
Well, you know, Julie, it's my first time on your show. I wish I had a pound-the-table asset allocation view. But my point is, between stocks and bonds right now, you don't want to load up on risk, in my mind, but also you don't want to be completely out of the market. So I go back to thinking about your strategic asset allocation. What is your risk tolerance? And how much stocks should you own in a quote-unquote normal environment? We're never in a normal environment. But right now, I would just stay close to center. You know how much risk you're willing to take between stocks and bonds. Kind of stick to that. That's a little bit boring, but you know what? This is the kind of environment where growth is decelerating, but it's still pretty high by pre-pandemic standards. And earnings are actually coming up, but all of this seems priced in. The fear gauge, the VIX index, this morning had an 11 handle. So, and we've had a great run in markets.
In other words, nobody's worried.
Yeah,
That's what that 11 handle means.
Which is when you want to be a little bit more worried than usual. We tend to be contrarian. We like to lean against the wind. And so right now I would just stay in the middle.
How much, Sebastian, if sort of your outlook, your thesis, how much is it dependent on the Fed and what they do over the next 12 months? How many cuts are coming?
Look, I think the market thinks about the Fed or talks about the Fed or even reacts to the Fed way too much right now.
But it's hard, Sebastian, because they don't stop talking.
I know.
That's part of the problem, yeah.
I know, I'm with you. But look, we're looking at a market that I call it narrative ping pong that is sensitive to a 0.1% difference in a monthly inflation print. Why is that? Because the Fed is telling everybody they're going to be data dependent. And guess what? The month-to-month data is pretty random. There's a big unpredictable component to it. So we're on a knife's edge. But if you think about it, 25 basis points, yeah, probably rates are coming down, probably one cut over the next 6 to 12 months, maybe two. Does it really make a huge difference? We had a 550 basis points rate shock, and markets have been quite resilient thus far. So the economy and ultimately I think markets have become a bit less sensitive to the Fed, even though we're obsessed with it and we just keep talking about it. Look, in our portfolios, actually slightly short duration. So we think that there's probably upward pressures on rates due to upward pressures on inflation. Wages are still growing over 4.5%. That's not consistent with 2% inflation.
And finally, I know you don't have a pound the table kind of conviction call, but is there anywhere, be boring, maybe be mostly boring, is there anywhere you think people should sort of reach for risk? Any areas?
So believe it or not, even though credit spreads are pretty tight, the way we position the fixed income portion of our portfolio is a barbell between cash, which, by the way, because the yield curve is inverted, cash will give you 5+%. That's pretty nice. And credit, so actually long credit. So we have this
investment grade credit?
Yeah, investment grade credit, even high yield, even emerging market debt. You diversify the credit exposures. In stocks where we're a little bit contrarian because we've seen so much flows into growth stocks, that if you want to position for the market broadening, I would not necessarily do it with small caps. I would do it with large cap value stocks. There's a wave of AI productivity coming, and some industries that have not been touched by the magic of AI are actually going to start to get spending productivity increases and so on, and it's going to help. By the end of the year, by the way, the value stocks are expected to grow their earnings year over year faster than the growth stocks. That's because you have very easy comparables for value stocks. But there's a passing of the baton that if you look forward, not backward, because that hasn't worked so far, but if you look forward, you can expect that broadening.
Well, it turns out there's a lot of different investment ideas in Be Boring.
Yeah. You know what? I'll say this. I am aggressively, convincingly neutral between stocks and bonds. I'm pounding the table to be neutral.
Okay,
Strong
fair
neutral.
enough.
Yeah.
Thank you so much for being here. Really appreciate you being in studio with us.
Thanks.
Well, let's get to some earnings numbers. Workday just out with its quarterly results in the past few moments here. And just looking at the numbers, first quarter revenue coming in at $1.99 billion. That's very slightly ahead of what analysts had been anticipating. First quarter earnings per share, $1.74. That is well above the $1.58 that analysts were anticipating. You see the shares falling, though, some 8%. And that looks like it has to do with the forecast, perhaps. Second quarter subscription revenue, the company's forecasting at about $1.9 billion. Full year subscription revenue at $7.7 to $7.73 billion. And full year operating margin, it looks like it's actually raising its forecast for that to 25%. So we'll have to dig in here a little bit and see exactly what is going on and why there might be some disappointment.
Yeah, the company's bread and butter, of course, really finance and HR products. And the question will be on that guidance and kind of the puts and takes there. What are they seeing really in the general spending environment? International, by the way, they had highlighted in the past as strength, so interesting to see what trends they're seeing overseas. The margins are interesting because I know the street had questions about sales, marketing, R&D, and the trajectory there because the company's been investing in Gen AI. heading into the print, this stock was not working. It was already down about 5% so far this year, and we're down about another 8% now in the after hours.
Yeah, just looking at this a little bit more here, it looks like the company did cut its subscription revenue guidance for the second quarter, its fiscal second quarter, which ends July 31st. It says that subscription revenue will grow 17% to about $1.9 billion. But Carl Eschenbach, the CEO, making some comments here in the statement and sort of pointing to maybe that is the area here. And Zane Rowe, the CFO, says our updated subscription revenue guidance reflects the elevated sales scrutiny and lower customer headcount growth we experienced during the quarter. So it looks like perhaps that's what's going on.
There'll be a lot of questions there.
Yep.
All right, coming up, we're going to check in on a few more earnings reports, the latest from Ross Stores and Deckers Outdoor on the other side.
Let's check out some more earnings here. Shares of Ross Stores are higher after that company's numbers beat estimates. $1.46 in earnings per share, 9 cents ahead of estimates. Comparable sales rising 3%, although that's a little shy of the 3.4% estimated. An operating margin at 12.2% ahead of estimates as well. Company also giving some forecasts for its second quarter for comparable sales of 2 to 3%. That's fairly in line with estimates. And earnings per share of $1.43 to $1.49. That too pretty much in line with estimates here. It looks like their full year forecasts are as well. There is one comment that our executive producer helpfully flagged here. Barbara Rentler, the CEO of Ross Stores, saying ongoing uncertainty in today's macroeconomic and geopolitical environments, including prolonged inflation, continue to squeeze our low to moderate income customers' purchasing power, and they said it's more important than ever to offer them the best branded values possible. They said they'll continue to manage inventory and expenses tightly as a result of that.
Yeah, this was another name like Workday, by the way. Not a lot was expected. I mean, the stock was in the red year to date heading into the print, so you have a nice pop here, a nice read, I think, for investors into the macro, into the consumer. And about the guidance too, as a analyst will often say, Julie, this is one where, a typically kind of cautious management team in terms of their forecasts.
Right, exactly. And next up, we've got a Deckers Outdoor. Those shares also higher on the sales beat here. Fourth quarter sales of $959.8 million, comfortably above $884 million that analysts had been anticipating, and now coming out with some 2025 forecasts as well, which pretty much meet estimates here. Although the earnings per share forecast, it looks like, is a little bit shy of estimates. Sales forecast in line with what analysts had been anticipating. I was looking at the brand breakdown here. Decker's, of course, the shoemaker behind UGG. UGG sales up 49% last quarter. Hoka sales, that's brand's been pretty hot, up 34%. However, my beloved Teva's not doing as well. Teva sales down 15.6%, and Sanic, I'm not sure how you pronounce that shoe brand. Those were down by 39.1%. So kind of a split. I mean, Hoka and UGG are the bigger brands by far for them, and they grew. But the other brands lagged.
Incredible stock move in this name. It is the Nvidia of footwear. I mean, really, heading into this print, this thing was up 35% a year. It's up around 100% over the past 12 months.
Yeah. What kind of sneakers? We've talked about this before. What kind of sneakers do you have?
Sneakers?
Yeah. Do you own any sneakers?
I'm not a big sneaker guy.
None?
I'm not a big sneaker guy. I'll tell you what, though.
What do you wear to the gym?
Let me tell you, sandals. By the way, there are some people who are bullish on this name. Acceleration in sandals. That's what they see ahead.
Well, Hoka's have been. Wait a minute, guys. Sorry.
Yeah.
Do you wear the cowboy boots at the gym, Josh?
I didn't, but now the image is in my head, and I feel like I should.
It's like a Lenny Kravitz kind of situation, Josh. Josh Lipton at the gym.
That was an amazing image, Kravitz.
Okay, sorry for
right.
We got a hard turn.
We move on. Tensions are rising between Taiwan and China. Beijing holding military drills near the island for 2 days, calling it punishment after Taiwan's new president pledged to defend its sovereignty, a situation that could prove problematic for U.S. AI players, given Taiwan's key role as a global semiconductor powerhouse. And here to discuss further, Chris Miller, Assistant Professor of International History at Tufts and author of Chip War, the fight for the world's most critical technology. Chris, it is good to see you. And it's a great time to have you, Chris, because listen, we've been talking a lot about Nvidia. They reported, they beat, investors loved it. And when we talk about Nvidia, Chris, a theme that does come up is we know that TSMC, of course, is actually making Jensen Huang's chips, and in Taiwan, a real, of course, geopolitical hotspot. And I'm curious, Chris, for chip investors who are listening right now, should they think of that as a kind of long-term risk, Chris, that they need to be aware of, not just if you're in Nvidia, but in a lot of names that rely on TSMC actually make those semiconductors?
Well, I think you're right that almost the entire U.S. chip industry, all of the leading chip design firms rely quite heavily on production in East Asia and especially in Taiwan. It could be a long-term risk, could be a shorter-term risk. Nobody really knows. But the fact that the entire U.S. tech sector is dependent on one pretty small island does present a risk that I think investors have to take seriously.
And by the same token, there are implications for China itself when it comes to where its chips are being designed, particularly advanced chips, the kinds like Nvidia designs, right? They're trying to sort of foster a homegrown advanced chip making industry. Can they successfully do that?
Well, you're certainly right that China is focused on this issue. We've seen China make a lot of strides at the lower and the middle range of the market, where China's probably going to be close to self-sufficient in producing lower-end chips by the end of the decade, if not slightly sooner. Where they face real challenges is at the high end, the most advanced processors, like those that are used in smartphones or used for AI applications. And China's got some volume of relatively advanced production capacity, but when it comes to the most advanced manufacturing, right now it's all in Taiwan. And that represents a roadblock for Chinese firms that want to compete with Nvidia and AI chips or with other companies in PC processors or in smartphones.
And how much, Chris, obviously the U.S. government, is telling chip makers, you're not sending your latest and greatest to China, but how much is that really sort of hampering China's ambitions to be a chip powerhouse?
I think it's certainly a challenge for China when it comes to access to chip making tools like the lithography equipment produced by ASML in the Netherlands, which in its most advanced versions can't be sold to China at all. That's a real hindrance to China's ability to manufacture more advanced chips. I think it's more uncertain whether the restrictions on the sale of AI processors to China is really slowing down China's AI ecosystem. It's true that we hear voices from China, people who say they face deficits in getting access to all of the AI processors that they want, but you actually hear the same things from American companies as well, who are also struggling to get their hands on all of the Nvidia chips that they'd like to buy. So I think it's less guaranteed that those controls are actually having the desired effect.
And Chris, just quickly, the other side of the tariffs and restrictions put on China are the incentives here in the U.S. for building homegrown chip production. I know we're years away from that really being finished, but once it's complete, how resilient will it make chip supply chains?
Well, we're seeing a ton of investment happening in the chip industry in the US, multiple different companies, both US and foreign, in a series of really tremendously large projects. And this is going to make a major difference in the US chip industry. We'll be producing a lot more chips domestically. It won't mean complete self-sufficiency, but it does mean a lot more resilience, especially in case of a political crisis in East Asia.
Chris, thanks so much for your perspective. Really helpful.
Thank you.
The Justice Department is suing Live Nation, the parent company of Ticketmaster, alleging the company has a monopoly over live events, harming fans, artists, and venues in the process. Joining us now, Northeastern University professor David Herlihy. David, thanks for being here. So the remedy that the Justice Department appears to be looking for is breaking up the company, right? A merger that they approved back in 2010 of Live Nation and Ticketmaster, they essentially want to undo it. Does that fix the issue that they seem to be trying to fix?
Not really. This is a very complicated space. The live music ecosystem has several different players. You have artists, you have managers, you have venues, you have promoters, you have ticketing, concert promoters. And I think it's very difficult to really regulate this in a way that's not going to still get abused by companies that have a dominant market share. And so I don't think there's really any silver bullet here. It's interesting. It'll be interesting to see whether Ticketmaster is indeed broken away from Live Nation. But it's I don't think it's going to fix it now.
David, let's say that the government actually won this thing and there was a breakup. What did a breakup actually look like?
Well, I guess you'd have essentially there would be no opportunity for Ticketmaster to really directly connect with Live Nation. There would be a standalone ticketing company that could provide their services to any promoter. I think so. It would be essentially, although the 2010 consent decree required Ticketmaster to provide its code and its system to competing ticket services. Essentially, I think having one ticketing company that provides agnostic services to any promoter at any venue, I think that's what the government is looking for, as opposed to sort of these integrated deals that enable Ticketmaster to work with Live Nation and to do certain kinds of deals that sort of cross-pollinate and create multiple opportunities for Ticketmaster and Live Nation to double dip.
I've got part of Live Nation's response in my inbox here, and one of the things they point out is that they say there's more competition in the live events market, and they say that Ticketmaster's market share has actually declined since 2010, although I think it's still something like 80%.
Right.
So I guess the question is, what would be the remedy? I mean, one of the things in this email that Live Nation is proposing is letting artists cap resale prices. We know the resale market is one of the things that really gets people's attention.
Well, I think how do you really do that in an effective way? I mean, you have people that are buying tickets and then they're reselling the tickets. And there's this effort to try to figure out how much should we charge? What's the right price to charge? And Ticketmaster is also engaging in dynamic pricing to make sure that, that's like when you're buying an airline ticket, depending upon when you buy it, how many seats are left, the price fluctuates. And so it's a real conundrum, I think, to try to figure out what is the exact best price. But the secondary market, I mean, how do you control somebody from selling a ticket that they bought legitimately and on a secondary market? And the truth is, a lot of artists are themselves on the secondary market, as is Ticketmaster. And so it's a very difficult ecosystem to control. It's actually multiple different ecosystems that each operate in a free market, and they're trying to regulate this in such a way that it won't damage consumers. It's a very difficult. There's no silver bullet here that's going to just make this work.
David, let me ask you. We are in an election year. Let's say there's a change in the White House. Could that affect this in any way, or no? Neither Biden nor Trump would be riding to the rescue for Live Nation.
Well, I don't know that anyone's going to want to ride to the rescue for Live Nation. In a way, it's funny because Ticketmaster is sort of the fall guy for artists, and Live Nation too. What's not really realized is that the artists are the ones that set the prices. People have this illusion that Ticketmaster comes in and says, we're going to charge this much money for Bruce Springsteen, or this much money for Taylor Swift, or this much money for Beyonce. The artists are the ones who actually set the high watermark that begins the whole offering to the public. And then you have a secondary market, which may show that the prices were lower than they could have been. And so I don't know that really anybody wants to come in necessarily and save Ticketmaster, especially when you have Taylor Swift fans and their parents who are outraged at the way that the whole ticketing availability came into play. I don't think there's really anybody that wants to own this in terms of like being the champion of the fiasco.
David, thank you. It's a big, complicated story. Thanks for walking us through it.
Sure, happy to help.
Time now for what to watch Thursday, May 24th. Starting off with the Fed, we're going to be getting some Fed commentary from Fed Governor Christopher Waller in the morning. It's coming after comments from Waller in an interview this week saying he does not think further interest rate increases will be necessary and suggested a rate cut could come at the end of the year if inflation data continues to cool down.
And taking a look at the economy, another piece of economic data coming out tomorrow. That's the monthly durable goods report. After seeing an increase last month, economists are anticipating that number to go down, giving us another indicator of the overall strength of the economy. That number does tend to be volatile.
And finally, could we see the approval of the spot Ethereum ETF? Deadline for the Securities and Exchange Commission to approve or deny an application from Van Eck is tonight. We are standing by for the decision. What would approval mean? Investors will wait to see if one or more ETFs will be able to start trading immediately or whether there will be a gap between approval and when trading can actually begin.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it is our new show, Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Yahoo Finance's brand new show, Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. The crypto clock is ticking. The Securities and Exchange Commission is set to make its decision soon on a spot Ethereum ETF. We're going to dive into the implications for the broader crypto market next. Plus, home buyers rejoice. 30-year mortgage rates fallen below the 7% threshold for the first time in more than a month. But can the momentum continue? We're checking the trends at play in our chart of the day. And the beauty industry faces an ugly reality over concerns that consumers are pulling back their spending. We're going to talk with the chairman and CEO of Elf Beauty on the consumer trends that brand is seeing. We're awaiting a decision here from the Securities and Exchange Commission on a spot Ethereum ETF. For more, we're bringing in Matt Bollenswag, Managing Director and Go Network Head at BitGo. Matt, it is good to see you. So let's just get right there. Spot Ethereum ETFs, Matt. What do you think? Are they going to get the green light?
Thanks so much for having me on. Great to be here. I do think they're going to get the green light here. I mean, I will say, I'm actively watching crypto Twitter as we speak, and I'm hearing rumblings that this might happen, right after 5 p.m. I've heard other reports that it might take still a few hours, but all signals point to that this is getting approved today.
Can I tell you, Matt, if this gets approved, I was dead wrong, because I really thought, I'm interested to get your take, I really thought SEC Chair Gary Gensler, I mean, he did not want that spot Bitcoin ETF. He had to be dragged to it, Matt. It took a lawsuit. I honestly thought there was going to have to be another lawsuit if you were going to greenlight a spot Ethereum ETF. Maybe you saw it differently, Matt.
Look, I'll say this, from a trader's perspective and from the institutional side of crypto, I think we were all very, very shocked to see how fast things have developed this week. Especially just to your point, knowing the pace at which the Bitcoin ETF, unfolded. So hearing the news earlier this week that the SEC was asking some of these ETF issuers to amend their 19B4 filings in preparation for an ETF spot approval was very, very surprising and was not priced into the market at all. I mean, Ethereum was trading around 3,000 flat and immediately has spiked now up to 3,700. And it's not just the ETH ETF approval, but there seems to be, I think, an intentional pivot by the current administration to signal really a support for digital currencies. We saw the Senate overturning SOB 121 last week, which would have made it really hard for banks and large dealers to hold crypto on their balance sheet. Obviously, that still has to get through the president. But there was also a landslide approval yesterday in the House of Reps for crypto's financial innovation and technology bill of the 21st century. Which had both Democratic and Republican support. So, that baton is now with the Senate. But whatever the catalysts may be, it's becoming clear that I think Congress wants to be on the right side of history here and have the U.S. really be at the forefront of this movement with innovations in finance and tech globally, like we always have been. So I think this clearly matters to voters. We also have an upcoming election. So, whatever those catalysts are, I think everybody in the institutional crypto world is very surprised at how this has progressed, but very happy.
And Matt, let's say you do see the spot Ethereum ETFs get the green light. They're approved. What do you think, Matt? Take out the crystal ball. What do you think demand is like, and where do you think demand comes from?
Yeah, it's a great question. I mean, I think you can use the Bitcoin ETF as a proxy and kind of, guide to understanding this at some point. And if you just look at the flows of the Bitcoin ETF in the first few months here of trading, it's been a funnel of capital into the ecosystem. I think we saw 1.1 billion of net inflows in just the last 5 days and about 13.5 billion of net new demand holistically for the asset. So there's obviously a tremendous institutional demand pool out there. And, Ethereum is going to be something similar to that. Maybe it'll be some fraction of that. But obviously, I think there are a lot of interested parties that now have the rails needed to add Ethereum as a part of their portfolio. But even more importantly than just being, the actual funnel of capital into the asset, I think it's really the initiation of really a whole new class of investors becoming educated on the ecosystem. You have folks, you had folks like Larry Fink, right, explaining the value prop of Bitcoin as a decentralized, right, non-sovereign, internet-based, inflation-resistant currency and what that means. And now, investors are going to have to go a little bit further down the rabbit hole to understand, well, what about the Ethereum ecosystem? What is smart contract programmability? How do decentralized exchanges work? What are the other alternative layer ones out there, and how do you balance things like consensus with speed? So all of these questions that us in the institutional crypto world have been exploring for some time will now become mainstream, and I think that's going to be a huge benefit to not just ETH, but a lot of the other layer one protocols out in the space, over time. And I do think we're going to see a lot of capital come into the crypto ecosystem as a result of this Ethereum spot ETF approval.
And Matt, I'll get you out of here on this. Let's say we do see a spot Ethereum ETF. It's approved. It gets the green light. How does that kind of impact and influence the price of Ethereum, Matt? What's your guess? I mean, 12 months out, give me a target.
Yeah, all right. 12 months out. I think ETH will certainly challenge, if not hit, all-time highs. So wouldn't shock me to see a 5,000 handle on ETH 12 months out from now. So I'll stick with that.
Matt, thank you so much for joining the show today. That was great. Appreciate your time.
My pleasure. Thanks so much for having me on.
A wild day on Wall Street. Stocks closing the day lower, even as the Nasdaq and the S&P 500 hit record highs earlier in the session. Jared Blickery is here with the takeaways of the trading day. Jared.
Thank you, Josh. I'm going to start with the flash PMIs that we got at 9:45 a.m. Usually not a market-moving report, but we did see it move the market this morning, mainly the bond market. And we saw yields which were negative on the day, down a couple basis points, surge 4 or 5 basis points. So I have an interesting quote here from the purveyor of the report. This is S&P. What's interesting is that the main inflationary impetus is now coming from manufacturing rather than services, meaning rates of inflation for costs and selling prices are now somewhat elevated by pre-pandemic standards in both sectors, to suggest that the final mile down to the Fed's 2% target seems elusive. So we've been talking about manufacturing strength kind of yielding to services strength. And now with the latest few reports here, we do see the goods sector picking up again. Yep. So what's the Fed to do?
This is the question. So that was my question. Do you see this, Jared, as sort of, was it kind of one more data point to you of, okay, getting back to Jay Powell's 2% target, maybe a tougher slog than some people had expected?
Yeah, I think a lot of the evidence nowadays is pointing to that, one hiccup after another. Now, the city economic surprises, those have been trending down. So U.S. economic data has been a little weak, and that has kind of buoyed the notion that the Fed can cut rates. However, we keep seeing these outliers, and this one was a big one today, just judging by the market movement.
All right, let's get to the next Jared Blickery bullet point here.
You bet. We're looking at the VIX here, and I'm going to put up a chart of the VIX. Now, we opened the day at the lowest point of the year. This is a 3-month chart. I'll put a year-to-date chart on. This was the lowest point of the year. And so the VIX, when you have a lower amount, that just means there's less.
So that was a reversal there.
Yes, this is a big reversal. Let me just put a 2-month chart so you can see this candle here. That's a pretty big candle. Now the VIX is oftentimes the reverse of the equities market. So if we look at the S&P 500, the benchmark stock index, there's that big red candle. This was a record high. Sometimes you gap to a record high, and that just means you open at a higher price than the day before, and then you trend down. Well, this can be a reversal signal. Here's another year-to-date chart. You can see we had one of these candles after, it wasn't a record high, but it was a very similar situation. So we've seen this before. A lot of times these candles happen at highs. I don't want to raise the alarm bells too soon, because it depends on what happens tomorrow and the next day, but could be a top here, at least short term.
That was my question, is you look at that chart, Jared, what is sort of the signal that's sending to viewers right now, investors?
This is a yellow flashing signal to me. So this tells me that I need to be on alert the next couple days for some more down action, because we may be in a distribution top right here, similar to what we saw. Now, this doesn't mean that we're going to enter a bear market, and that's a whole other conversation, because this was definitely not a bear market. But all I'm saying is that after a run-up like this, we might be due for a pause. And then just based on what we saw in the semiconductors, we can take a look at that in a second. Well, it's just kind of more evidence for that.
Let's go to the next bullet point. Let's go to the semis.
You bet. So I've been watching, and actually today is the 100th market day of the year. And so what I'm looking at, copper and chips, because both are actually up 23% this year. So I'm going to show you a chart of both put together. And it's funny because copper and chip stocks, they kind of go together. We saw this recent run up in copper, and here copper is in light blue, and here the Philly Semiconductor Index is in purple. But you can see both of these have ended up on the same price. That's just a coincidence, or the same return amount for the year. That's just a coincidence, but they are related. And so I thought this would...
There's a relation, so you're saying there's a relation between the red metal and the semis?
Yes, there is. Because copper goes into chip stocks. Not chip stocks, copper goes into chips themselves. It goes into the architecture, the backbone. You need wires to conduct electricity. So copper is a basic building block of chips, and also the infrastructure of how information is transmitted. So they're kind of hand in hand here. I think the secular trend is that we're going to see material prices go northwards. But what was interesting about this today too, and here's another side point, is that we did see that drop in the stocks, but we saw copper take a big hit yesterday. Are the two related? I think it's too early to tell, but I'm going to be paying attention to chips and some of the raw materials and those prices in the future.
All right, Jared Blickery. Thank you, my friend. Appreciate it. Coming up, a look at the trends driving the housing market as mortgage rates fall below 7% for the first time in more than a month. More asking for a trend on the other side. Home buyers rejoice. 30-year fixed mortgage rates fell below 7% for the first time in more than a month this week. That's according to Freddie Mac. Now we're in the spring home buying season, of course, historically busiest time to grab a new home. But sales have been low this year as higher rates take their toll. So what's the supply picture really look like? Julie Hyman takes a closer look in our chart of the day. Julie.
Yes, I know someone on the other side of the camera there who's participating in that spring buying season. But be that as it may, home buyers may rejoice at those slightly lower mortgage rates, but not at the availability of homes for sale on the market. And this chart coming to us from UBS's John Lovallo, who tracks publicly traded home builders. But this right here is existing homes on the market for sale, the supply of those existing homes. And we did see that number improve a little bit, the inventory improve a little bit in April, up 9% on a month-over-month basis, but still, as you can see here, is very depressed. Okay, so what if you want to buy a new home? You layer that on top, you're still seeing it at pretty historical lows. Although, if you can see, we are seeing the margin gap up a little bit. In other words, we are seeing home builders build more homes because they see an opportunity here as there are fewer existing homes on the market. So a little bit of a wider margin than you have seen in recent years. And then there is, as Lovallo points out, the historical perspective here. So what you're seeing is this dotted line is the historical average going all the way back to 1982. Now, you can probably see that this is way above where we are right now. And not only that, it is 1.6 standard deviations below that. This is one standard deviation. What does that mean? It's just a math term to say we are way below the average in terms of the housing supply that is out there, Josh.
And Julie, we were talking off camera about this. Not so surprising, right? Because we were discussing if you were locked in at 3%, 4%, you're not moving. I mean, what would be, you would really need a strong motivation to move because you're going to be probably swapping your 3 or 4% for something closer to 7%.
Well, guess what? The motivation is price, Josh, in many cases, because as we know, the median home sales price in April ticked up to $407,600. So that's what we are seeing, that trade-off.
No inventory will do that.
That'll do that. Now, from Lovallo's perspective, all of this is fairly positive for home builders because, again, they are seeing an opportunity here. But for people who are still trying to buy a home, this is not a very encouraging picture yet.
No, you just have to be really desperate, like your co-anchor, Julie. That's the move.
I'm not going to say that, but you can describe yourself that way if you like.
Thank you, Julie. Thank you. Coming up, the beauty industry in store for a slowdown. I'm going to speak to the CEO of Elf Beauty on the other side. We're asking for a trend. Still to come. e.l.f. Beauty crossing over $1 billion in sales for the first time ever in its fiscal 2024, continuing a trend of rapid growth for the cosmetic brand. Its fourth quarter revenue and profits surpassing Wall Street forecasts, though a less ambitious outlook for revenue in the upcoming year sparked fears of perhaps a consumer slowdown could be around the corner. Here to discuss is Tarang Amin, e.l.f. Beauty Chairman and CEO. Tarang, it is good to see you. So you report your Q4 results beat. Investors like what they heard, Tarang. Your stock surges almost 20% in today's trade. Let's start there, Tarang. Walk us through what drove the business in the quarter.
Well, I think it's a combination of our exceptional, consistent category-leading growth, and that consistency. It's our 21st consecutive quarter of net sales and market share growth. We finished the year, our fiscal year, at 77% growth in net sales, over 100% growth in adjusted EBITDA, and we picked up 300 basis points of market share. So I think it's a combination of that consistency and leading growth, as well as the white space we still see ahead of us. We feel we can double our share in color cosmetics. We have two of the fastest growing skincare brands in skincare, and we have major white space opportunity internationally. So I think the combination of two things is what investors are appreciating.
Hey, Tarang, it's Julie here. How much of your continuing success also has to do with the price point at which you sell your products, which is below many other competitors? And what does that say about where the consumer is right now?
Well, I'd say definitely value is one of the things we're most known for. Our ability to take the best of beauty and make it accessible to every eye, lip, and face. We have a unique ability of having prestige-like quality at these extraordinary price points. And that certainly is resonating now, but it's resonated throughout the 21 quarters I'm talking about, whether the pandemic or the category is strong or container imbalances, it doesn't really matter. Our community is responding to our value proposition, our powerhouse innovation, and our marketing engine that knows how to engage and entertain our community.
And Tarang, you mentioned the opportunity you see overseas, internationally. Where exactly, Tarang, internationally, do you see the most opportunity? What looks especially attractive here?
Well, in the last quarter, we grew our international business 115%. That primarily was from the first two countries we entered, Canada and the UK, where we continue to increase our rank. As we think of international expansion, I think first priority is on Western Europe. A few months ago, we entered Douglas, Italy. We quickly became their #1 brand. Last month, we entered Etos in the Netherlands, quickly became their #1 brand. What we're seeing is there's pent-up demand in these countries before e.l.f. gets there. Primarily given the strength we have in social in the U.S., consumers know about e.l.f. well before we're there, and we're definitely seeing that in terms of how much the brand resonates.
Tarang, I also want to ask you about the so-called lipstick index, right? This thinking that even if economic growth slows, that people are willing to spend on little luxuries like lipstick. Now, in that situation, how do you guys do? I mean, is there a risk that people actually would, if they're not spending on more expensive items, maybe that they would trade up when it comes to their makeup, or what have you seen?
Well, we've seen strong growth across the board, both prestige as well as the mass side. And so that effect is, it is a small luxury that is so important to be able to express yourself. The great news for e.l.f. is we've seen strong growth, whether the economy was bad or the economy was good. And I think the real insight here is you used to have to pick. You'd either do prestige brands, but it would cost you a lot of money, or you went kind of value. The best of what e.l.f. really offers is that prestige quality, these incredible value equations. So consumers are telling us, e.l.f. is actually better than prestige. So why am I spending so much more when I can get e.l.f. and these incredible products that we have?
Tarang, I want to switch gears a little bit because you guys started a bit of an unusual marketing campaign recently where you were pushing for more board diversity with a very catchy tagline, among others, too many dicks, meaning too many Richards, white men named Richard perhaps, on corporate boards, and talked about needing more board diversity. Right now we are seeing a lot of companies sort of lean back from pushing these kinds of initiatives. Why did you guys decide to go, pretty provocatively in that direction?
Well, it's something we really believe in. If you look at our success, yes, we just talked about how great our products are, the value equation, our innovation, our marketing. Probably the biggest driver of our success is our team and our culture. And we're very intentional in terms of how diverse our team is. 75% women, 65% Gen Z and millennial, 45% diverse. We feel our employees are the community that we serve. We feel it gives us a leg up. And it's not just our employees. We're one of only 4 corporate boards in America out of 4,200 that have 2/3 women and 1/3 diverse representation. We feel it's been a major driver of our success, and we wanted to do our part, not only the right thing to do, but also as good corporate citizens to shine a light on. And the tagline is, so many dicks, not enough of everyone else. And by the way, there's nothing wrong with being Richard, Rick, Dick.
You guys have one on your board, right?
We do, and he's a phenomenal board member. So this has less to do with not wanting them. It's more to do with, the Richard, Rick, Dick. I think there are twice as many as Hispanic women directors in the U.S., almost as many as Black directors in the U.S. So it's more about really encouraging and shining a light of including others. And we've seen that to be a major benefit for us. And we want to do our part and make sure that others know that they can call us. We're also partnering with the National Association of Corporate Directors to sponsor 20 women and diverse candidates for their Accelerate program to be able to get them. And we really want, it's part of what we really believe. We serve a diverse community, and it's important. Our community actually really appreciated this campaign, that you're standing up for something that a lot of companies don't stand up for, but it's core to our values and our purpose.
Tarang, thanks so much for joining the show today. Appreciate it, and thank you, Julie, as well. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.